All right. Hey, everyone. Welcome. And thanks for taking the time on this cold morning to join in live. Always do appreciate that. As always, most people will watch the video on recording. So I've got the mute button on, and we'll just kind of jump right into things here. All right. So those of you that were able to join us live yesterday while corn was rallying, we did a short Facebook Live to show you kind of exactly what we were looking at. And I think I'll start there with the technicals. But before I do that, let's just kind of talk about what's going on in the fundamental side of things, right? So from a bearish standpoint, what we're still talking about is this lack of demand. Our crop size is known here. There's really just no new supply showing up that people are going to want to start, um, or that's shocking people. What is happening on the bullish side is three things. We've got oil rebounding a little bit. We've got the CPI number more bullish than what people might have thought, which has caused the dollar to move to 6-month lows. And we've also got a little bit of a bullish story in Argentina. Although if you really look at the bull story in Argentina and in Brazil, you realize that it's really not that bullish just because of the Brazilian weather is really pretty good. So having oil and the CPI number, oil up and the dollar down, should be providing a little bit of buying interest to our grains, and it really just hasn't done that. I mean, we've just been funds have just been selling corn like crazy, and so it makes you wonder what really is going on. But what we talked about yesterday, we've had these big consolidation zones going back all the way through September, right? Where we've consolidated sideways, and then we just can't get any momentum up out of them or down below them. And then that started to shift with this move lower, this sideways move, and now this one, right? Where what date is this? The 1st of December is when corn kind of started to roll over, and it violated all these lows. And we had identified the 653 level as a really important one, simply because if you look back on the chart, it's a level that has held 7 different times going back through April. And anytime that happens, it should speak to you when it's either provided resistance or support for that long of a period of time, and it has. So here we are again, and we've traded back up through it. But what we saw yesterday that really interested us and made us think that yesterday's rally was probably going to end with weakness is this right here. We broke out of the down move, right? We broke out of this range. We rallied back, but we rallied just back to the bottom of it, and we never broke back up above that 60 level. Yesterday's high print was 660 on the dot, and we never traded back up inside this range, and we never violated the hedge line, and we never seriously tested the bottom side of this trend channel that's been developing since October. So that's why we thought that this would be meaningful, and it makes sense, right? If something is holding a support and then it turns around and becomes resistance, it should happen pretty quick. You shouldn't be able to trade back up into it. And that's been a characteristic of this market for a while, where you break high and then you just can't hold it. You break the high and then you can't hold it, and you just cannot get anything to latch and keep going. The market is just getting beaten up. But corn really started, I think, yesterday to establish that, hey, we can reverse, we can hold support or resistance, and we can start to work lower. So now all eyes should be on the 644 level, because I think if it breaks, then I think that's gonna result in lower lows, lower highs, and that would be 1 lower high, 2 lower highs, 3 lower highs with successive lower lows, which is a downtrend. So I think we're going to get even more aggressive selling if we do reverse down from here. I do want to point out that there are some analysts and some Elliotistians out there talking that this sequence from from October down to the December low, complete a 5-wave structure, and they're looking for a 3-wave move up into this area right in here, which would be capped by this high at 77. So we think we stay below it. We don't really subscribe to that theory, but anything's possible and it can happen. So we could get a rally back up into this 70, 75 area, but I think it's unlikely, and well, it's got to come up into the 60 area first. So it's disappointing the way corn is trading with as many bullish fundamentals as there really are. The weakness is characteristic of the market shrugging off bullishness, and we're going to find out something bearish at some point in time that'll catch a lot of people off guard. All right, December corn. Now, if you look at March one more time, take a mental picture of where we are. Right, we traded right up to the bottom of this of these lines, and now we look at December, and we never even got close. You know, here's yesterday's high. We never even came close to this little spot right here yesterday, and so that was really a big tell to us that the deferred months were not nearly as strong as their nearbys, and that made us apprehensive that the rally was going to persist. So like corn, or like March, December is working a series of lower lows, lower highs, and you know, that's just going to persist until we get some sort of meaningful recovery bounce or some sort of news that's going to really change the market. Okay, soybeans, old crop soybeans. This is March beans right here, and you can just see at a glance exactly what we're doing. Right, we're contained inside this wedge, and that's been holding since July. It's long, it's nasty, it's and it is really difficult to trade. We will break out the top. We will break out at one point, or sooner rather than later. It will happen, and generally, when you do break out of a range like this, the move will be equal to the widest point. So that's from 12.98. So call it 13 to 15. So you're talking about a $2 move out the bottom or the top, either direction it goes. That's your most probable move. And we believe that it should be lower. And we think that because of the impulsiveness of this move. We think that because of our wave counts. We think that because of our divergences. And we think that because of the weather in South America. So there's lots of reasons why beans would roll over and go down here. So like corn, like corn has reasons to go up, beans have reason to go down, and if we break out the top side of it, it should really we've got to pay attention, because it might tell us that something is going on. So can this market rally out the top and then turn around and die and head fake everybody? Oh, absolutely it can. In fact, it's done it. It's done it already once, right? Where it breaks up and comes back down. There's just no momentum to the downside. Moving around. Sorry, I've got somebody calling me. I'm trying to pass my phone off here. Okay. So with beans, we're biased to the downside for sure. We are. We'd be surprised if we do get the bullish news that people are looking for out of here. But for now, we're just going to sit and wait. I think it makes sense to wait until the bottom side gets broken before we really turn too bearish and try to take short positions, because we just don't want to get chopped up too much up in this area. New crop beans. New crop beans have a similar formation, except it's even tighter. The wedge is further to the right on the chart. It takes fewer days to draw it, and I think it's gonna come to an end sooner rather than later. So what will push new crop out the top? Well, probably some sort of weather event that we don't really know about yet, or it could be new demand that we haven't heard of. But I think if things stay status quo and we don't get a surprise, I think this is going to roll over as well. And I think the bottom of this comes, at least to the lows that we had last July, and probably quite a bit lower than that. So I think with the size of crop coming out of Brazil, remember the Brazilian crop is going to be 30 to 50 million metric tons more this year than it was a year ago. So that's over 1 billion bushels, or right at 1 billion bushels of additional new supply above what they grew a year ago. And that is not bullish for us at all, given our situation. Everyone says, well, what about biodiesel and all of the long, the new demand and all those things that are coming and are kind of bullish fundamentals underpinning our market? Well, they're all there and they might play out, but they've also been known about for a long time. So, you've got to actually build the plants, you've got to create the demand in order to sustain a long rally. So beans probably will rally, but from where, I don't know, and that could easily be sub 12 on new crop beans. It could easily be sub, call it what do we say, $2 on this move? So sub 12.20, somewhere in there. And if I run our Fibonacci numbers off of this, so pick it here, we're talking a move at least down to 12.89, if not down to 12.14 on March beans, just off of this count, which is going to count from here down to here. So if I run it from over here, it counts lower, right? It counts all the way down to 11.50 and even lower. So not a whole lot of bullish fodder there. We need to get up and out of here if it's going to happen. Okay, Kansas City wheat. This one's really, really tricky because in wheat, we actually have a few more bullish fundamentals than we do in corn. Our crop is not off to a good start. We know that. We know that the dollar is at a 6-month low. We know that oil has been rebounding, and we know that at least some of wheat has been tied to this inflationary talk. We also know that the hostilities have increased in the Ukraine. We know that instability is very real and present. We also know that other countries that have promised to export wheat to the world and overwhelm us with supply, like India and Australia, have been unable to do so because their crops just haven't been nearly as powerful or as big as they had once thought. In fact, India, instead of being an exporter, has actually canceled a lot of their exports, and their prices are at new highs. So they're trading above where they were trading back in May, with the war at its highest. So with wheat, it makes it really difficult to want to sell this, but I think we have to. I don't think we have a choice. I don't really want to turn bearish wheat down in here, but I think this is the move that we need to sell. And I think we're going to sell it, and I think we're looking for a move down into the 780 range as an opportunity to lift our hedges. And then I hope we get a bigger bounce after the new year at some point in time. But with corn rolling over and wheat tracing a very similar pattern to what corn is doing, I don't think it's prudent to not hedge it at this point. I'd hope that we'd get a little bit bigger rally up to like 915, 950, but I just don't think that we're going to get it. So what we're going to be doing with people today is selling selling futures and selling a put down to this range either today or some point down in here. The reason you would do that, the reason you would sell a future and sell a put, okay? So let's talk about that. When you sell a future, you are penny for penny with the market, right? If it goes down, you make money. If it goes up, you lose money. Very simple. When you sell a put, you're giving yourself a little bit of wiggle room. So let's just, for argument's sake, say that we sold a 750 put. Well, what that means is that we are giving someone the right to put wheat to us at 750 a bushel. So if the price drops to 650, we're giving them the opportunity to make us buy it at 750. So we could lose money as the put goes down. Now, when you, but what they're giving us in exchange for that right is the cash. So let's say that this put is 30 cents a bushel. Well, they're going to give us 30 cents a bushel in exchange for their right to make us buy their wheat at 750. Now, if wheat expires or if wheat trades stays above 750 through expiration, then we get to keep our 30 cents and we have no obligation to anyone else. If you sell futures and collect 30 cents, your futures entry point is not 850. Your futures entry point is 880, which is close to where we want to be anyway. So you're collecting both, and then you will collect the entire distance all the way to 750 plus the premium that you have that you collected. So if wheat trades, if we sell it today and it trades to 750, your futures trade will make $1, and your put, you will keep your premium, and so you will have basically sold at 720. So you'll have made $1.30, and you'll be out of those short futures right here at 750 at expiration, because they'll just offset the put. So you're not taking any additional risk. You're actually reducing your futures risk and giving yourself a little bit of a buffer. And so you can sell futures here and sell a put and have a little bit less downside risk or upside risk than what you had originally taken. And the reason I want to do that is because I want to make sure that this low gives away. If this is let's say that this is an A and a B down into this level right here that might hold, and then we turn around and rally, I want to make sure that we're prepared for that eventuality, because we just want to make it sell it higher. And we can do that right now by just selling 880 wheat, by selling the 750 put against the 850 futures here. So that's just an example. I'm not saying that that's the exact trade that we're going to take, but that's an example of what you can do and how you can use an option position to actually help increase the sale price against it. So I wish we'd have sold wheat right back in here, but the market just really wasn't telling us to do that, and I wish that we had gotten a little bit more strength yesterday, because it would have worked a little bit higher. But like corn, wheat is responding negatively to bullish news, which is concerning to everybody. Okay, that's what I've got, everyone, today. Pay attention to texts and alerts on the wheat position that we'll be recommending. I do think it's prudent to have something. If you have futures accounts, you should do it there, because that gives us plenty of time to adjust for market movements, and I understand that our crop is uncertain, to say the least, and so overcommitting in the physical is something we want to be careful about. Remember, there is risk trading futures and options, and it may not be suitable for everyone. So if you're going to trade, make sure you trade in light of your own financial condition. We will talk to you next Wednesday. I hope you guys have a great week.